Okay, let's do a Q&A for Sunday's market outlook. And listen, I am aware of the buzz in the background. It's the room I'm in. I'm going to have to change rooms and do this in another location. But to do that, I need a hard wire for the internet connection. So I'm waiting for that to happen. But if you are listening to this and you're saying, what's that buzzing in the background? I'm in a room where there's a whole bank of electronics that run the whole house, and it's just making a hell of a lot of noise. Anyways, let's go. Let's see. Would you briefly discuss the tax differences between Canada and Costa Rica? Yeah, it is an interesting conversation to have. I'll do a separate video on that. Let's see. Now that there's almost full consensus that this tightening cycle has reached its peak, would you be compelled to make a short recap video? First of all, with me, there's no such thing as short. A short recap video for posterity and your initial expectations, frustrations, lessons learned. My frustrations. There is no short video on my frustrations this year. Strictly macro. It's been enlightening to follow your thought process since Jackson Hole. I think, let's take three big things: beta, duration, and the Fed. I think I've been pretty good on the Fed in terms of the rate hikes that I thought that they would do. Not initially when they started raising rates. I didn't think they'd be as aggressive as they did, but since Jackson Hole, I think I've been fairly spot on. I think I missed only one. So I think I've been fairly good on that. Duration, I think I was decent on until the bear steepener happened in September, October. But playing the probabilities, bear steepeners at elevated rates are extremely rare. So who would have thought? And then beta, I don't know what caused beta to keep performing all year into July. I'm going to go ahead and say a lot of it was AI, most of it was AI, and usually shocks like that, technological shocks, these are exogenous events, meaning that they're difficult to predict when something like that is going to take a hold. 2023 was not a year for macro, I'll tell you that. Can you do a video on the process of moving out of Canada, the reasons you chose Costa Rica? Yeah, I will do that. A fellow Canadian citizen looking for a way out as well. Let's see. Overall on this entire move up from 42, vol has been coming down. I think it's just last week we saw a bit more IV. VIX also finished the week marginally higher, suggesting puts were getting more of a bid. How do you feel about thinking of this as potential bearish divergence? Well, I guess if you look at Monday and Tuesday, it kind of looks that way, right? We lacked follow through on the index. You finished at the high of the year on Friday. The SPY printed, and not only just the high of the year, it printed a 52-week high, but had no follow through Monday and Tuesday. A lack of conviction, I guess, to bring the index higher. So, I don't know what to make of that. However, the market was underperforming significantly more today before the JOLTS report came out. JOLTS, and I'm going to use a joke here, really gave a jolt to the market, to the upside. So I think there's going to be caution until the Fed. Why do we use 10-year Treasury against a 30-year fixed rate mortgage as the mortgage spread? Two big reasons. Number one, a 30-year fixed rate mortgage is fully amortizing. So if you look at cash flows and the duration, it has a duration very similar to the 10-year bullet bond from the Treasury. The mortgage rate is usually the 10-year plus some spread. So that's why we compare it to the 10-year. And 10 years also useful because it is one of the most efficient forms of interest rate hedging against mortgages or against MBS. Let's see. Congratulations. Thank you. I'm also considering retiring to warmer latitudes. Costa Rica is on my short list. Based on your boots on the ground research, what region, town, or neighborhood in Costa Rica is best geared to wealthy Western retirees? Anything on the Pacific, stay away from the Caribbean, only because the drug trade is concentrated on the Caribbean side, not the Pacific side. high-end villas, good infrastructure, restaurant safety, private medical care. You can get that anywhere. The more you are on the coast, the less likely you are to get reliable, and when I mean reliable, always up utilities and internet. So that's a whole conversation. Assuming I'm able to gain the risk-free rate as a cap gain on cash. No, you cannot. The risk-free rate is not a capital gain on cash. If you buy a T-bill, you may think it's a capital gain. So a T-bill is a pure discount bond. It's a zero coupon, meaning it has 0% coupon. You'll buy it at like 95. 3 months later, it matures at 100. All of this is considered interest. None of it is considered a capital gain. Money market securities only produce interest, and that's how it will be treated on whatever tax forms your broker gives you for holding it. It is interest income, not a capital gain. But it's interest income out of the U.S., not subject to a withholding tax, simply because there's nothing to withhold. There's no coupon. Would using ES for my passive U.S. equity exposure be reasonable in a taxable account? Well, ES, we think that it has negative carry. It has an explicit negative carry. But stock has an implicit negative carry. So let me explain that. Let's say that the index itself, the cash index, is at 4,500, and you look at a 3-month ES, a futures contract, and you find that it is sitting at 45.30. You may say, well, if the market goes up 30 points, by the time it expires, I will just break even. So I do have negative 30 of carry. You could make that argument and say, well, I see the carry, but the carry is explicit. You can see the difference in the cash price and the futures price, and you can calculate the carry. But let's say that you took SPY, and we'll just say SPY selling for $4.50 a share. And just to make it at 4,500, let's say you bought 10 shares at 4,500. Well, now you have 4,500 in SPY as opposed to 4,500 in cash. Well, cash would have earned 5.5%. So by putting it in SPY, you are giving up 5.5%. You're giving up the carry. You would have had positive carry by holding the money market security. So that means when you buy SPY, and let's say that that comes to $30, I'm just showing you how it's the same thing. That means that SPY would have to go up to at least 45.30 for you to be indifferent. In other words, you would have said, but I could have made that in cash. So basically, all I've returned is the risk-free rate. I haven't really made anything, have I? So the only difference between the futures and the stock is the futures will be explicit about the carry, but the stock is implicit because this is an opportunity cost that you're foregoing that most people don't consider. I believe this would be near carry neutral on the interest component on the forward price. There are no free lunches, so if you're looking for something that is neutral on carry, there really are no free lunches here. So what you can do is you can use a futures contract to get exposure to SPY, and then the money that every ES is for 50 shares of SPY on average. So if you buy one ES contract, you'll have money left over. You won't be using the money to buy 50 SPY. If you put the difference into a T-bill, right, you will get the cash rate. You'll at least get the cash rate, but you'll have a negative carry over here. So it'll just, basically it just cancels off. But it's the same as if you had just bought the 50 SPY and ignored the ES. The ES, you'd ignore the explicit carry, and you're giving up the implicit carry. Comes to the same thing. Let's see. What do you think are the factors that explain the different performance of the economy in U.S. versus Canada? Canadian economy is far more leveraged the household is far more leveraged than the U.S. economy. Canadian unemployment rate is not below 5%. The U.S. unemployment rate is below 4%. The costs of certain things, for example, the running costs of a household are significantly higher in in Canada than in the U.S. So things like your utility bills are higher in Canada. Things like internet access are higher in Canada. Things like your cell phone bill are much higher in Canada. So because these things take up so much more of your disposable income, the amount left that is being spent in the economy on goods and services is a lower proportion of your income than it is in the U.S. Number one. We have a much more punishing tax system in Canada than you have in the U.S. One thing that you have in the U.S. is the mortgage interest deductibility from your income. We do not have that in Canada. You have 30-year fixed rate mortgages. Canada has 5-year fixed rate mortgages, 25-year amortization, 5-year fixed. So, every day in Canada, there are people walking into banks resetting at significantly higher rates. So financing charges, first of all, Canada is much more indebted than the U.S. So financing charges are taking a big chunk, and the costs of just maintaining a household take a bigger chunk in Canada than they do in the U.S. And the tax take is much higher in Canada than it is in the U.S. Those three things. If you want to see the difference, higher cost of living, when I say higher cost of maintaining a household and higher taxes, if you want to see the difference that it does, Q3 Canada negative 1.1%, Q3 US 5.2% real GDP. I think those things are a big deal. Now there are a whole bunch of other things I can point to. Canada is not really a capital intensive economy like the US is, meaning we don't have as robust a private equity industry, we don't have as robust a venture capital industry. So we don't have the level of innovation and growth that the US has as well. So there's a lot of positives that you can say about the US system over the Canadian system in terms of achieving growth and productivity. American productivity has outstripped Canadian productivity for decades. Americans are more productive than Canadians. Let's see. I have a question on sector rotation. How would you assess if markets look past through some event in the near future? For example, after Friday, iShares Core S&P Small Cap ETF is up from 96 to 100. Before it, I thought the Consumer Staples Select Spider Fund might be a correct place to park a certain percentage of the portfolio. Not only after the first rate cut by the Fed make a move into IJR. Now I have doubt that I may be too short-sighted. You got to be careful about some of these rallies, these big broad-based rallies. Everything goes up. That does not mean there's going to be follow-through. We're seeing right now, Monday, Tuesday, there's no follow-through. Everything will go up. Look at Beyond Meat. Went from $5 to, $9? On nothing. Only because when the market goes up, almost anything will go up. This is where you have a confusion sometimes when new people come into the market. If it's a bull market and the market's going up and new people come in and they start day trading the market, they're going to make money. They buy and they sell, they buy and they sell, they buy and they sell. They're going to make money because 90% of stocks go up. And then they end up mistaking luck for brains. They were lucky in that they started investing in a bull market and they're making money, so they think they're smart until the market changes on them. So it's when you have a day where everything's going up, even garbage is going up. That doesn't mean you've missed anything. It's just there are very few days in the year where most of the stock market's returns are concentrated. Usually, over a course of a year in a bull market, there's maybe 20 days which will make up like 90% of the market's moves, because you'll have the market do stuff like this, and then you'll have this kind of stuff, and then it does stuff like this, and then you have this kind of thing. It's usually about 20 days out of the year in a bull market, which will make up the majority of the returns. And there you get the expression, it's about time in the market, not timing the market, because if you miss those particular days, you can miss 80-90% of the year's returns. So I wouldn't make any conclusions on one day. Recent volatility in bonds. As you probably know, Bill Ackman has a bet that yields will go up, meaning yields will go down. And seems he has been right. He closed his position and took his profit. Okay, well, you're talking about a month and a half ago, that he closed his TLT position. I mean, this is history, right? He has since changed his mind, and he's long bonds, and he's thinking yields will go down. Question is, do you think it was luck that made Bill right? Did he know something the rest of us didn't? Nobody knows. Nobody knows something that the rest of you don't. Nobody knows anything about the future. Nobody, no matter what they tell you. Don't give $20 to that woman looking in a crystal ball telling you she knows the future. Nobody knows the future. However, you can have certain beliefs about what the future holds based on conditions today. Also, if you have a voice, you can create the very condition you predict. So if you have enough followers, if you have enough people that listen to you, and you say event X is going to happen, so this is what I'm going to do, you can create enough people acting in a way because they believe event X will happen. You have enough people acting in a way that actually creates and causes event X to happen, right? So it kind of can become self-fulfilling. If you have a big enough voice and enough people follow you, you can say things that can create the very future you predicted. So let's not forget about the power of your voice. And whenever you take a position, don't take it quietly. You need to get onto CNBC and as many shows as you can and scream it very loudly. This is what I'm doing, because what would be the point of keeping it quiet? And if you're using your voice a lot, you have to lean to the belief that part of your strategy is your voice. Not so much that you have a better insight than anybody else, but that you have a louder voice than anyone else, that your voice has more reach than anyone else. So it could be that there was an element of that involved, right? But as far as somebody knowing something that nobody else knows, when it comes to something like duration, not really. No, nobody knows anything that you don't know. No. In your opinion, what do you think the key factors are contributing a large gap difference between Canada and the U.S.? Okay, I already explained that. If one wanted to gain downside S&P exposure with limited loss potential, would buy a put or do a bear spread with puts? Yeah, on ES be the ideal way to get it done. Yeah, well, you said right off, limited loss potential, which means you want defined risk. Defined risk means you pay some money for something and that's the most you can lose is what you paid. Your risk is defined. Seems like exposure could be gained on the cheap, say 44 to 43.50 bear put spread for under $300 a contract. Yeah, I just think that once you get past the Fed, if the Fed is on hold and in the press conference, if they signal that they are now in phase 2, you're not going to get bearish sentiment going into the end of the year. So I don't know that the end of the year is the time to do it. If there is going to be some issue, it'll either be Q1 earning or Q4 earnings, or some kind of fatigue going into the new year with Fed officials maybe going on speaking tours trying to correct phase 2, saying everyone thinks we're going to be cutting soon. We're not. And that's what it's going to take. And then perhaps for yourself, what would you need to see in order to go short ES again? I don't think I would at this point. The market behavior just doesn't lend itself well to it. and we've had 500 points to the upside. Margins are holding up, and we're still with record profits. This is not a shortable market when the behavior is comfortable at 19 and a half times earnings, willing to push it to 20. That's not a market you can short, because you're shorting behavior. That's a brutally hard thing to do. If the fundamentals don't matter to the crowd, all you can do is run with the crowd or just step aside and stay out of their way. B of A just released their top 10 trade ideas for 2024, and the top of the list were all bond trades. I agree. Do you suppose that now is a great time to build out a bond position? Oh my God, October was a great time to build out a bond position. I was picking up zeros, 2048 zeros at 5.55, 5.6. Where are they now? 4.7, 4.6. October was a great time. Listen, Warren Buffett says a lot of, I think, really beautiful things in short sentences. When the time to buy is when there's blood in the streets. It's hard because there's blood in the streets, and you think, I'm not going in there. You hear Jamie Dimon talking about 6 and 7 and 8% bond yields, and the markets, bonds have been selling off. TLT going from 100 to 95 to 90 to 85, 84, 83, and it's hard to step in, but you have to step back and think, hang on, this is the U.S. government. What are we kidding here? That was the time to buy. But yeah, I still think it's a good time for duration, because rates aren't staying at 5.5%. I do believe that we live in, especially North America, a demographically challenged world, which is deflationary. Technology is deflationary. And the more unions get higher wages, the greater the case is made to shift investment from labor to capital, which is deflationary. And we are seeing productivity gains and unit costs coming in negative, which is deflationary. I think we get more data this week on unit costs. So, being that we live in a world in which I think deflation is going to be the bigger challenge. To think that it's inflation, you have to think that productivity is going to be flat to negative, which means that technology is not going to be of any help whatsoever. That has just not been the case of history. About your applied level course, and I'm wondering about sequence of education. How should we start? Wherever you want. That's the thing about it. It's not sequential. You just jump in and start wherever you want. All that moving and hustling, and although we got some reverb, you didn't miss a beat. Oh, well, I'm sure you're hearing more reverb, more background noise now. Just reapplied for my 2024 healthcare coverage, and the premium went up 15% along with the higher deductibles and out-of-pocket costs. U.S. healthcare, since this should show up in core inflation right at the holidays, I wonder how the Fed will respond to it, since it may also reduce demand in more discretionary services. Yeah, so this will show up. Most of that shows up in CPI, but not PCE. Okay, so CPI will measure that any cost, any increase in healthcare insurance, but PCE won't pick it up, because the PCE is what the consumer pays for. Very few consumers pay for their own healthcare. Most, the lion's share of covered Americans, Medicare, Medicaid, and employee health plans. I think it's like 6% of the U.S. population actually pay for their own health care. It's a very low number, which means the weighting in PCE is super low. So even if it has outsized price increases, its weighting is super low, because PCE measures what the consumer pays for, whereas CPI measures a basket of goods and the prices regardless of who pays for it. Are you going to begin deploying capital into equity market again, or do you need to hold off until 2024? No, I don't need to hold off. I just need to get the transfers done. So I have to transfer. Everything had to go to cash and sit in and go into US dollars and either sit in cash or sit in bonds. Then you initiate a transfer of that from Interactive Brokers to JP Morgan, and then that can be deployed. All of that takes time. All of it takes time when you're moving, when you're moving a certain size. It's not something you do overnight. It takes time, and then you have to line it up with something called a capital dividend, because some of it's coming out of the business I own. And if it's coming out of the business, you can't just pull it out of the business, because you'll end up in a very tax inefficient place. If you have capital in the business, there's usually a capital dividend. You have to elect to declare a capital dividend. It has to be approved. Then you can take that out tax-free. Otherwise, ugly, ugly taxes. So all of these things take accountants, which take invoices, and it takes time. Approaching retirement, want to get your opinion on using covered call ETFs as part of IRA to increase income versus using an income factory. You can actually buy ETFs that employ a covered call strategy. You can actually buy them. Some employ a 50 delta covered call strategy. Some employ a 30 delta covered call strategy. So there are ETFs that will do covered calls for you. You don't actually have to do it yourself. But you can if you want. Several popular ETFs sell 20, 30. Oh, you already got it there. Yeah. Having 0.65 beta, 12% yield using U.S. large cap dividend stocks is the underlying. Not much NAV appreciation, but the income and lower beta drawdown seems attractive. Yeah. Yeah, that's basically what you get, pretty much doing it yourself, right? So, yeah. Does your applied series have a segment on valuing REITs? Yeah, well, not valuing REITs, understanding REITs. I don't go too much into the valuation of them. I go into the understanding of them, and then it puts you in the position where you can then value them yourself. But as a retail investor, it's an exercise that's not going to add a lot of value to you, because especially if you're using discounted cash flow, forget it. You're not going to have enough information to get that done. You're not going to have access to information to get it done. And the precision that you're looking for is wasted on the retail investor. What you want to know is, does this have some good upside potential? Is it safe to be in? So you want to be able to judge, well, where you're going to be. Are you going to be in timber REITs? Are you going to be in residential REITs, office REITs, retail? No point valuing an office REIT, just stay the hell away. No point valuing retail, just stay the hell away. Retail's been shrinking for I think since the mid-'80s, retail space in the U.S. has been shrinking. Timber REITs, yes, I think that's a good place to be. Healthcare REITs, I would stay away from healthcare REITs, not because healthcare sucks, is because hospitals can't hire staff. And if hospitals can't hire staff, they can't book the number of operations or whatever it is that they do. So they can't say, okay, well, let's do this many knee surgeries. Let's do this. Let's do that. You don't have nurses. You can't get the doctors. You can't get the healthcare staff. You can't sell the procedures. If you can't sell the procedures, well, then you're not generating the revenue to cover your rent, or it makes it look difficult or challenging to cover your rent, especially older medical facilities. So healthcare REITs have taken a big hit, not because healthcare has taken a big hit, but because you can't get the staff. And if you can't get the staff, you can't sell the procedures. So the revenues are taking a hit because you can't staff up. So understanding that gets you on the road to beginning to value it. Somebody's trying to leave the room here. Just slide the door open and head on out. All right. Let's see. I'm interested in valuing healthcare REITs. Oh, look at that. I just went on a rant about healthcare REITs. I would stay away from healthcare REITs until we find some way, or until the labor issue has been dealt with. My opinion, return to office is unlikely to ever match pre-pandemic levels. You'd be surprised. You would be surprised. The more and more companies are realizing that the work from home cohorts have two characteristics: low productivity, number one, and low ambition. That they don't want to be in the office. They don't want extra responsibility. They only want to work so many hours a week. They're looking to work fewer hours a week. And this is not me talking. This is some research that came out of Stanford. that comes to these conclusions. And I've read some research that says, oh no, it's great because of this and that. And it's usually taking the point of view of the employee, how much better the employee's life is. Well, no kidding. No kidding, it's so much better. But you got to look at it from the other point of view, right? I think the further we get from the pandemic, the more we will return to what the work from home cohort used to be. And look, work from home has been around since the 80s. There are some people who don't work in the office. Outside sales is a good example of somebody who may come into the office every now and then, but they basically work from home or they work out of their car, and they always have. So I think more and more companies are seeing that, you know what, as the labor market loosens up, as we have choices, we don't have to be this flexible. 2 years ago, somebody wanted to work from home, IT wanted to work from home. It's like, well, we have no choice. We really have no choice. I think on a going forward basis, as the labor market loosens up and you do have choice, it'll be, well, you go ahead and stay home. I can replace you. I think you'd be surprised. Sorry. However, I still wouldn't invest in office space at this point, because this could be another 2-3 years before we finally get back to where we used to be. And I think some office buildings need to go away first. Aging population, people still need health care and long-term services and support. Yeah. A couple of the REITs I have started to look at also operate senior care facilities. Got to be careful about the senior care facilities because ever since the pandemic, more and more regulation has come into that space, and that raises their costs. Not only that, they still can't get the staff, and if you can't get the staff, you can't go to full occupancy. So be careful about that. Given the lack of supply of housing in Canada in the coming decade, is there a good Canadian home builder to invest in? I really wish there was. There simply isn't. There's no national home builder, no. Next one. With Canadian REITs, I assume the thesis is growth in population and low vacancy rates translates to increased rental rates to drive company top line growth. That's exactly it. If you're young and on the other side of that equation, how would you look at what is economically more valuable right now? Continuing to rent or buying, assuming a non-payment and mortgage serviceability. Considering, not paying rent but mortgage serviceability are within reason. How should one think if it makes more sense to continue to rent or buy? Well, you just do an analysis of the two. With renting, you know how much you're going to lose per month. You know how much you'll lose for the year. Buy a home, you're going to pay more. You're going to have property insurance. You're going to have property tax. You're going to have house insurance. You're going to have bills on the whole house. You're going to have maintenance and repair. You're going to have lawn to take care of, snow to shovel. So you can't just say, well, a shovel is cheap. How much is your time worth? How much time are you going to spend shoveling snow if you're in a northern climate? How much time are you going to spend on your lawn? Then, of course, there's your garden. Are you going to plant new flowers? Are you going to take care of the shrubs and the hedges? Is it an electric lawnmower or is it a gas lawnmower? How much are you going to pay for that? How much time are you going to use on a Saturday? So there's a lot more costs involved in maintaining a house other than just, well, this is how much I pay every month. First of all, you will pay more, but there's an equity amount that you're building up over time. Rent doesn't have that. So you have to ask, is the amount of time I spend working on and around the house going to be worth it? Even though you don't have to pay for a new roof your first year, even though you don't have to pay for new windows your first year, even though you don't have to pay for a new HVAC system your first year, what you do have to do is price that out. And then usually they're about 20-year replacements. Your roof is maybe a 7 to 8 year, maybe a 10-year replacement. Your HVAC units are 20-year replacements. Certain windows are 20-year, 30-year replacements. You got to figure out what the depreciation is on the house on those parts, because 8 years from now you're going to spend $12,000 to replace your roof. Well, if you're going to do that $12,000 every 8 years, you got to figure, well, even though I'm not paying for it this year, I got to put away $1,500 a year just to replace my roof in the future. Your HVAC system, what's that going to cost you? 10 grand every 20 years. So you got to put away another $500 a year for that. There's a lot more costs involved in owning a house. I just don't think with mortgage rates where they are and with housing prices having not come down significantly, really, especially in the US, I don't know that it is cheaper to buy than it is to rent. Level 2 vids, you mentioned private credit picking up as a leading indicator for a recession. I think you mean consumer credit, not private credit. Would you be able to explain the intuition behind that? We're certainly seeing a pickup in private credit. Some may say the golden age of private credit. Not private credit. Consumer credit, sure, but I don't know why private credit would have anything to do with it. What's your opinion on gold? I've said this many times. I have no opinion on gold. It's not something that I follow. Why does it fly to record highs in such a period? Well, we all know it's a non-yielding asset. Any concern about loosening the money supply or loosening monetary policy, which would increase the money supply or at least not tighten it, might be a signal to the gold bugs that, oh my God, inflation is coming, the dollar is going to devalue. It could be something like that. I'm not a gold bug in the least. I don't follow gold at all. It's just not something that I find very useful when I'm investing to invest in something that only has value because of fear of something else. And gold seems to derive its value from fear of something else. So, I don't know. I would rather be in copper for the next 5 years than gold. If I had to be in a coma for the next 5 years, put all my money, if I had to choose between copper and gold, put all my money in copper. Don't give me this gold stuff. What else we got here? Any suggestions how to manage currency risk while owning the underlying? Yeah, the last video I put up actually I think it was a couple sessions ago for the in the applied level portfolio construction, I showed you how to take a position. I took a position in a euro stock in BMW, and then showed on Interactive Brokers how you would hedge out the cost of carrying that in euros. There is a bit of an echo in the video, but you can't really hear the electric cables. Well, they're loud now. They're loud now because more of the house is turned on. So this whole there's a whole bank of lights that are just blinking and flashing and doing all sorts of things. I am going to move the office to another room, so I think this is the last one you'll hear this echoing. Let's see. What specific REITs do you have the most exposure to? Canadian apartment REITs. Difference between PCE that comes out with the second look of third quarter GDP. So one is a quarter, one is for the quarter. There's PCE. You got to be careful now, right? You're not looking at PCE, you're looking at the PCE index. PCE is personal consumption expenditure, which is the C component of GDP. That's not inflation, that's just the personal consumption expenditure. How much did that expenditure grow by? You have to look at the PCE index, and it's just for the quarter, as opposed to being month by month. So it's weighted over the quarter. Let's see. Give us a day in the life vlog. I guess I could do that. Do you take explicit steps to limit confirmation bias? I don't know if I take explicit steps. I don't know that I take explicit steps to do that. When you are on a theme like I have been with copper and Canadian apartment REITs, you look at the data, and it's based on inventory levels, production levels. For REITs, it's based on occupancy, based on the population growth from all sources, based on the amount of new housing units that's coming onto the market. It makes a very bullish case. to say that, well, you're suffering from confirmation bias because you see the bullish cases. Well, sometimes there is a bullish case. There's more of a bullish case than a bearish case. So I don't know that I take any explicit steps. I don't, when I'm looking for some information, I don't type in words. So for example, I don't type in Tesla Cybertruck sucks and then just read everybody who thinks the Tesla Cybertruck sucks and then conclude that, the Tesla Cybertruck sucks. I was right. Because I'm basically searching for information that confirms what I already believed by searching for that information. So if I wanted to get, avoid confirmation bias, you would Google Tesla Cybertruck reviews and read them, good or bad. There's not much bearish. There's not much of a bearish case for Canadian apartment REITs now that we're at the top of a rate hiking cycle. Keep in mind, Canada uses IFRS, not GAAP. And because we use IFRS, apartments, the properties are basically listed at fair value. So apartment REITs took a lot of fair value hits to their income statement as interest rates were going up. Well, now, over the next few years, as interest rates go down, you're going to get a lot of fair value gains to the income statement, which means book value per share on all of these are set to rise. It's hard to make a bearish case against that when you look at just the facts. We can argue about what facts are facts, but I don't know that I have explicit steps to limit that. As much as I have, I don't try to encourage it by typing in Canadian apartment REITs bullish case or Canadian apartment REIT bulls and just listen to what they're saying. Are you considering re-entering your SPY short position? No, I don't think so, not at this point. Any thoughts on Stellantis, which trades cheaper than GM? The only issue I have with Stellantis, and I do think it's undervalued. The only issue I have is the Chrysler division. In Consumer Reports, their vehicles typically rank at the bottom of the list. Jeep was down there for a long time. Their pickup truck, the Ram, seems to just be at the very bottom. I owned one Chrysler one time, a Dodge minivan. Oh my God, it was the worst thing I ever owned. It was in 4 times under warranty. It had to be repaired 4 times under warranty. And it was just constant repair after repair. Never had that problem with a GM or a Ford. But in owning a minivan, it was years and years ago for a business I had, just the worst vehicle I ever had. And in Consumer Reports, if you look at the last Consumer Reports on ratings, Chrysler's always at the bottom of the list. So for Stellantis, it's the Chrysler division that I think is their Achilles heel. Their European division seemed to be fine, but it's the Chrysler division that just sucks. Maybe it's being held down by Chrysler. I think the first part of Chrysler is true. Cry, because that's what you do when you own one, is you cry. What else we got? Would love another poem video. That might be my favorite video of yours. Yeah, I could do another one. I've been itching to do something with Edgar Allan Poe. I think The Raven, the more I've been living with that one for a couple of years now. I keep going back and reading it, and you read more into it, and you reflect on it, and you look at it in different ways. Now, Poe, when he did that one, said nothing was a mistake in that poem, that nothing was a mistake. Usually, art is created, and as you're creating it, you end up with happy mistakes. You end up with an outcome where you go, that was lucky. But, it was your skill and your insight that saw something as it was developing, right? He was very clear on this when he said none of it was a mistake. Every word, every line was intentional. So you have to read it with that in mind, that no, he meant everything he said. And it kind of brings out some new meaning, because then you start seeing things you didn't see before. If it was intentional, then this over here can't be an accident. It was intentional. So now I have to read it, and see, here I go, I'm talking. You know what? I think I could probably do the Raven. I actually enjoy doing stuff like that. Yeah, let me see if I can get something for the Raven done, maybe New Year's Day, as a New Year's sort of thing. Let's see. Looking forward to seeing pictures next week. Sound quality is acceptable. Yeah, there'll be a bunch of pictures produced. I'm here till January 31st. Then the first 3 weeks of February, I got to be back in Canada. So the agent that I bought this from also manages B&B properties. And I said, can you do this one for 3 weeks? And she said, yeah. So they're going to take some professional pictures around the place, and we're going to do an Airbnb experiment for the first 3 weeks of February. So I can share those pictures when I get them. Why the expectations of a rate cut are now higher than they were just a week ago. Inflation is dramatically lower. Yeah. And yet the U.S. has managed to grow their GDP at this monster rate in Q2. Well, you have to understand what happened in Q3. Productivity was off the charts. Productivity was I think Q1 was negative, Q2 was Q3 was huge productivity. So yeah, if you have big increases in productivity, you can get growth with deflation. If your productivity is higher than your growth rate. Productivity was what, 4.4%. The GDP was 5.2. So if you control for productivity, GDP wasn't that great. If you make productivity zero. So you can get great GDP growth if you have high productivity and no inflation will show up. That was the Q3 story. So as long as we get good numbers, I think it's tomorrow we get these numbers. As long as we get good numbers for productivity and the Fed is on hold, we're golden. We're going to do quite well. Would you say? Who would you say are the real losers if something breaks in the CRE space? The real losers are probably going to be office and retail. Well, listen, retail's been losing for a long time. I think the big one here is office, especially Class B and Class C office properties. How bad do you think would that be for construction material demand like concrete? Yeah, concrete. Well, you know what? You got just as much infrastructure happening on one side. You've got what? 3 big bills that they passed. You have the Inflation Reduction Bill, you have the Infrastructure and the CHIPS Act, which encourages investment in new semiconductor facilities, which of course require building materials. So for the amount of new office buildings that will not be built, the 3 big spending bills from the Democrats, 2020, 2021, 2022, I think will more than make up for it. I don't understand. If I look at the yield curve, why, if we are experiencing, or we will, a bull steepening, and the long part of the curve reflects the expectations, we have rates going down. The long end of the curve will reflect it's a real yield. So in there you'll have a growth rate and an inflation component. So if we are expecting lower inflation, you will get lower yields on the long end. Shouldn't rates on the long part go up and rates on the short part go down? The short rates, 1 year and less, reflect the Fed policy. Until the Fed starts cutting rates, that 3-month yield is not budging. That 3-month yield is going to be 5.5% until the Fed starts cutting rates, period. And if we think inflation is going to drift away to zero and even go negative, long bond yields can continue to fall, and that curve will continue to invert from the money market to the capital market, meaning the 3-month to the 10-year. The 3-month rate will not drop on its own. Only if the Fed cuts rates will the 3-month rate drop. It purely reflects monetary policy. The long end of the curve reflects growth and inflation expectations. What might cause growth in PPP per capita to differ from labor productivity growth? Growth in PPP per capita. To differ from labor productivity growth. Um, Favorable exchange rate on, let's say, export-led economy. So you can have a, we're doing per capita. So again, that maybe not. I don't know. Off the top of my head, I don't know. I would say you could probably change tax rates. If you lower tax rates, you could probably increase the amount of economic activity between in the private sector, not the government sector, but in the private sector, and that usually has a higher multiple or multiplier than government spending, which means you would get higher GDP, higher levels of GDP for the same level of productivity if you give more money to the side that spends it faster. Without actually increasing productivity, you would get an increase in GDP without getting an increase in, you could get that increase without an increase in productivity if you change the incentive system. The big one, of course, the taxes. If you leave consumers with more money, and you leave the right consumers with more money, that means consumers at the bottom of the income spectrum, then yeah, you could get that. Taxes paid in Canada on investment income. 53% taxes on investment income. Well, my marginal tax rate was 53.5%. That applies to interest and U.S. dividends and Canadian REIT dividends. Selling of stock should have 50% of the profits, right? Yeah, so if there's a capital gain, then half of the capital gain is tax-free. The other half is taxed at 53.5%. Only selling naked options should be treated as income. No, that's in Canada, it is a capital gain. It is a capital gain. If you had made $1 million in profits a year, did you only take home approximately $470? Pretty much. Not if you make $1 million. You hit the top tax rate at around $230,000, right? So let's say you made $1,230,000. On the extra million you made at the 53.5% tax rate, you're absolutely right. The government takes 53.5% of that. So yeah, you're left with $465,000 on $1 million. The government is more than a 50% partner in your life. They're the majority partner in your life. After a certain income, they take the majority of your money. Yes, that is right. Still hope to hear that occasional rant about leftist politicians. Here's the thing. I'm hoping that we're going to be entering a world where I will no longer have to have rants about leftist politicians, where they will simply just be obsolete. And all of them, in time, this is my hope, will be embarrassed to admit that they were ever a leftist politician. But it'll be too late. We'll have a record of it. Hard to believe where the S&P is trading. Can't imagine a lot of upside. 80 basis points of equity risk premium, nearly 20x. 18 months of inverted yield curve, 1.5 years declining leading indicators. It does seem like the odds are stacked against that continuing. Let's layer onto that an aggressive union, a rising labor movement that is deciding that it wants a greater share of national income, which is taking away a share of, which naturally takes it away from capital. And not only just a rising labor movement, but a stronger union labor movement that is going to take away at least something on corporate profitability at some point. On the other side, AI has the ability, at least the belief is, that has the ability to replace all of these people demanding more money. Which one to believe? Which one to side on, right? GM will boost its dividend 33%, implement 10 billion share buyback program, attempt to spark interest among investors in a stock that has slumped this year. Why would GM care about its stock performance in the secondary market? Well, you have to. First of all, a lot of management and executive compensation is tied to stock performance. Not only that, you have a board of directors, and the board of directors' responsibility is to the shareholders, and the shareholders are saying, hey, if management can't get us a return on our money, then maybe we need new management, right? So they have to be concerned about the share price. You have to be. Enjoy that 20% tax rate. 0% income tax rate. 0% income tax rate, but not a 0% tax rate. There are taxes, and my taxes, based on my income, based on all the taxes I will be paying, come to about 5 to 6% tax rate blended overall, as opposed to 53.5%. Let's see. Any thoughts on the future of Berkshire Hathaway? I think the transition, if Warren Buffett went away, I think the transition would probably be like the transition Apple went through when Steve Jobs left. There may be some initial issue, some initial concern, but performance after that was fine. Performance after that showed that Steve Jobs left Apple in good shape with a good strategy. And I think Berkshire is the same. I think Warren Buffett has probably left his imprint on people, and I think that the philosophy that created what he's created will live on. And I think he's doing a good job of telegraphing this well in advance. So I don't know that I'd be worried about the future. Apart from How to Win Friends and Influence People and Thinking Fast and Slow, what other non-finance books do you recommend? That's a good one. I haven't read in quite some time. I wouldn't be in a position to recommend one at this point. What happened to Bloomberg's Real Yield? There hasn't been a new episode on YouTube in quite a while now. Yeah, I've noticed that. It's not on YouTube. It is on, they do still have Real Yield, but for some reason it hasn't been finding its way onto YouTube. I don't know. Market's already discounting 4 or 5 cuts over the next year as inflation expectations cool down. But why would the Fed cut at all? Because if inflation drops, if inflation gets really low, let's just take the 10-year, for example, and let's say the 10-year, we'll just put 4.25%. Well, the 10-year is made up of a real rate plus an inflation expectation. And so you got to pay attention to the real rate. Let's say inflation expectations keep dropping and keep dropping. Right now, the real rate on the 10-year is about 2%. So we can say the inflation expectation, or the break-even rate, is about 2.25%. Well, what if it falls to 0? That means the real rate goes to 4.25% if you don't cut rates. The real rate increases, and it's the real rate that is the restrictive rate, not the nominal rate. It's the real rate. Let me show you. Let's say that the 10-year is 4.25%, but inflation expectations are 4.25%. The real rate equals 0. That means companies that are looking at figuring out what the present value of a project is will say, well, on average, we can increase our price 4.25% a year. And what would be the interest rate at that point? What would you discount cash flows that are growing at 4.25% a year by, right? If you discount it at 4.25, well, it's the same as taking real cash flows and discounting them at 0%. Well, that's huge. That's great. That's big present value. So it is the real rate that matters. So as inflation expectations come down, if you do not cut rates, you're actually making monetary policy even more restrictive. And that is what Williams, the head of the New York Fed, usually talks a lot about, is that it may be necessary to reduce rates just to make sure that monetary policy is not getting more restrictive. Let's see. Let's review. GDP growth is solid. Yes. Unemployment at historically low levels. Wages and consumption remain healthy. Retail sales also healthy. Stuff. Okay, I get all your points here. I know where you're going. You got a long list saying, why would they ever reduce rates? Again, if inflation expectations drop considerably, the real rate increases, and in essence, they're actually tightening monetary policy. In other words, they're raising real rates by not cutting nominal rates. And that is a condition under which they probably would cut. When can we gather in Costa Rica to drink some cocktails and party on the beach? Yeah, well, that is a thought, right? 5-year real yields 2.02. 5-year break even 2.12. What do they mean? And how will a tips investor make money with this information? Okay, well, let's say that the break even rate is 2.12. And you expect inflation to be lower than 2.12. Let's just add the two up, 2.02 and 2.12. You get 4.24%. Now let's say that you think, okay, this 2.12, inflation over the next 5 years will actually average lower than that. Why not grab the 4.24%? Because let's say this drops to 1% on inflation. If it drops to 1% on inflation, you get 2.02 as your real yield because you bought a tips, and you get 1%, 3.02. 4.24 versus 3.02. So where does this 1% go? $1,000 is the face value of the bond. If after a year you have inflation of 2.12%, the bond is actually $1,021.20, and you'll still get 2.02%. So you'll get $2.02 on the 1,000. After the next year, you'll get 2.02% of the higher number. Then the principal grows at the rate of inflation. So if you think the rate of inflation over the 5 years is going to be lower than 2.012, you would rather have a fixed 4.24. But if you think inflation is going to be higher than 2.12 over the next 5 years, you'd rather have the real yield because your principal will grow faster than 2.12%. And that's why it's called a break-even rate, because it determines at which rate you would be indifferent. 2.12, you are indifferent between buying a tips and buying a nominal bond. Aren't they extinct? I believe they went extinct 100 million years ago. A long time ago. It's like this, by the way, is a dinosaur. If you ever watched, I think it was the third, or was it the second? I think it was the second Jurassic Park, when the family landed on that little island and the kids were playing, and all those tiny little dinosaurs, that kind of ran in a flock, size of a chicken. That's what those things are. Buy a few one by one. Oh yeah, make a triangular mountains. Yeah, unfortunately, this is just not the room for it. It's not that it's a wall of windows that don't absorb sound. It's all this electronic equipment in this one room. This is actually supposed to be the movie theater. It's got a big white screen that comes down, and a projector on the ceiling, and you can project your movie onto the wall. It's got really great speaker sounds in this room, but it's meant to be a theater room. And I just thought, wow, it's not a theater room now. And I see a desk. Let me put a computer on it. Nope. Let's see. Will there be a house tour video? Yeah, I think so. Why do we include government spending as a positive in the GDP calculation? Because the government takes money from you that you could have spent, and it spends it. Well, that's GDP. That's gross domestic product. It's actually employing people and spending money. So you have $100. They take 40 of it. You go spend 60. They spend the 40. There's the 100, right? Because you make 100, that means there's $100 worth of output. Because if we think about the identity that we learned in level 1, aggregate incomes equal aggregate output equal aggregate expenditure. Well, this is national income and this is GDP, right? Whether you're looking at it from the output or the expenditure perspective, this is Y. And this is national income. Well, national income equals GDP. You make $100. That has to be GDP. If the government takes $40 from you and you have 60, you got to get GDP from somewhere, so you have C plus G. There's the government sector right there, right? That's why we add it, because GDP must equal national income. The government takes some of your national income from you. Shouldn't there be a better calculation of our progress? GDP is deceptive since it promotes growing government, and we don't want big government. Um, Actually, GDP, if the government were 100% of GDP, we would be poor and miserable because the multiplier on GDP spending is extremely low. Nothing is more efficient than private sector spending. Nothing. So you can actually boost GDP by lowering tax rates without printing a single dollar more. It's just the velocity of money would increase in the private sector than it does in the government sector. So I think you're right in terms of GDP. I think the proper measure of a country's progress is GDP per capita, because if you take Japan, which will have a shrinking population over the next 10 years, it's going to be hard to get positive GDP growth. They'll have negative GDP because you have a shrinking population. The important thing is, do they have positive GDP per capita? So you can have your population shrinking but do better per person. So yeah, I think GDP per capita is the better measure, not GDP itself. By that measure, Canada sucks. GDP per capita in Canada has been going down for 4 years. We're actually getting poorer. Oh, hang on. Not we. Not me anymore. I'm not part of that mess. You guys in Canada, now look at that. You guys are getting poorer year after year, not we. I'm divorced from Canada. I left you. I still love you, but I can't live with you. All right. Hey, it's sad that we Canadian lost such a person as you, but I can understand. Regarding the Canadian housing sector, I know you said it's hard to invest because we can't find stocks like Lennar and DHI. But I've looked for investments in the subcomponent like lumber. Lumber's a tough one. Have you looked into another subcomponent? See, the thing is, we have a shortage of housing, right? And we're not building enough houses. So buying lumber is not going to help because we're not building enough houses. If you expected a housing boom, then I want to be in construction materials. If you expect a very tight housing market where there's just not enough houses being built, I want to be in the home builders. Do you get what I'm saying? If we have a housing boom, a ton of supply is coming onto the market, margins from the housing builders are going to be pressured downwards. But you're going to need more and more timber, more and more roofing tiles, more and more air conditioning units. So think about Trane, T-R-A-N-E, for example, more and more lumber. So you can think about timber REITs, or in Canada, it's most likely you're going to get the REITs mixed with a timber mill. Then sure, if I expect an explosion in house building, I want to be in building materials. But if I expect a tight housing market, well, the demand for building materials isn't going to increase, but the margins for the home builders are going to be great. So I don't know that you can say that you want to be in one, that you're indifferent between them. One is for increasing demand, one is for a tight market. I know you're already invested in copper idea, which is mostly for EV. Not just for EV, but you got to think about all these utility companies in weather-prone states with wires in the air. They're going to bury all those lines. Well, you're going to be burying new transmission lines. You're going to be taking down those towers. So you need a lot more copper. Utilities are adding capacity either through solar or with wind, which needs a whole new bunch of copper. India is going to be the third largest economy on this planet by 2030 in 6 short years. The amount of building and investment that takes, it all takes copper, because everything requires energy, everything requires electricity, everything with electrons needs copper. Data centers, data's not going away. Companies are collecting more and more data. You're going to need more and more data centers, which are hugely energy intensive. Think of all that copper, not just housing, and it's not just EV. Copper is in everything that is electric because that's the best ratio conductive price. It's not like we're going to start using gold or silver for wire. Let's see. Whoa, yo. Long on TLT, short on tips, no. Oh, is this a poem? Mind melting facts and figures, bruh. Double take on the S&P head fake, yeah? Thanks for sharing your gift. And is this a poem? Because I don't understand it. If it's not a poem, I don't understand a word of it. If it's a poem, I don't understand a word of it. Either way, I don't understand what's going on here, bruh. Anyways, making your way to the top step by step. I think that's just advertising. Buy YouTube views. Why would anyone buy their views? What, for just for pride reasons? Just I got 1 million views. No, you know you didn't. Like, why would you do it? You lose a metric. You lose a key metric. But hey, listen, it takes all kinds, right? Why are people migrating to Canada in so large numbers? Ironically, at the same time, you've just departed. Let me see if I can show you something. Let me see if I can find it here, first of all. I'm not sure if I can, but if I can, I'll show it to you. I'm not sure where it is. This was sent to me by somebody who has access to Panamanian news feed. Where is it now? You're going to get a real kick out of this one. I guess I can't find it. Give me a second here. No, that's not it. Maybe here. No, that's not it. Anyways, oh, here it is right here. Let's see if I can. No. Anyways, it was this thing that was in the in Panama, in the Panama news feed or something like that, promoting Canada, and it was saying, "Come to Canada. The government gives you free money. The taxpayers will pay your health care. They're happy to do it. You can get welfare for life." I'm not kidding you. It went on and on about all the stuff you'll get for free. There was a story in the London Free Press, London, Ontario, about students from Fanshawe College, which are mostly from India. And the food bank had to put a notice out to the students of Fanshawe College saying, "We are not free food." Right? Because when they were coming here, the recruiting company in India said, "Oh, you can get free food in Canada. You just go to this place and they'll give you bags of free food. You don't have to pay for food in Canada." That's why so many people want to come to Canada, because they believe that you get this stuff. Welfare for life, free food, free health care. The taxpayers, this ad said the taxpayer is happy to pay for it. Well, it's hard to argue with that when in reality, it's kind of true. If I can find that thing, every time I look for something in Gmail, I know I received it, I know I did, I go to look for it, Gmail says, I'm not giving it to you. And then I find it like when I don't want it. Gmail. Let's see. How did you make the decision to move to Costa Rica? Why Costa Rica? Do you know people there? It must be boring and or scary to move to a country without knowing anybody. No, it's not scary. It's not boring. It's not anything like that. You want to hit. What's with all these comments? I don't understand that. Is that part of a song? You want to hit? You got me. Doctor, the letter on EVs. When will we ever be ready? Well, we will. I mean, we'll be ready. You just need innovation behind it. But, about that letter, he's right. Or at least they are right. It is not ready. You have a lot of people who live in apartment buildings who don't have the ability to plug it in. You have people who live in units where they can't, if you live in a condominium and they have 3 plug-ins in the garage for EVs, you can't just install your own. You're kind of at the will of the building. The battery range sucks, and the battery range does have some problems in cold weather and hot weather. The other thing that they don't tell you when you buy these vehicles is they give you the battery range under ideal conditions in a straight, flat line. Roads are not flat. You're not going straight. You want heat, you're going to lose some range. You want to listen to music, you're going to lose some range. You're going to roll down your window with the electric, the electric window roller down or whatever you call it. You got electric windows. You're going to lose some range. Anything electric that requires energy in that car that you're going to use, you're going to lose some range. So when they say range of 320 miles, you're not getting 320 miles. You're not. Not if you want air conditioning in Florida, not if you want heat in Canada. You're not getting 320 miles. I'm telling you that right now. Under perfect conditions. Is it raining out? Are you using the windshield wipers? That's going to take your range. Why? Because the windshield wipers need energy, and they get that energy from the battery. Everything you do in an electric car. Are you driving at night? Are you turning the headlights on? You need energy. You're not going to get that range. So it is a misleading number that you're going to get that range. It's going to improve. Of course it's going to improve. Technology will find a way to improve it. But it'll probably have some kind of leveling off point beyond which you're not going to get much more capacity without changing technology. But does electric have to be 100% of the fleet? Can you not have a mix of hydrogen, plug-in hybrid, and electric, and electric for the applications where electric works, so in time, I think the technology will improve, but it's just not there yet. And what the dealerships are saying is, you're ramming it down our throats in such a short period of time, and it's not there. Like, it costs money to carry inventory on dealer lots. So when all these EVs are just piling up, as a business, you're saying, hey, enough is enough here. I can't. The buyers just aren't here for these cars. And that's where we are. It's just slow it down a bit. Like, freaking slow it down. Does it have to be 2030? It's not going to happen. By the way, it's not going to happen in 6 years. I'll tell you that. It's not going to happen. In a couple of years, you get to 2026, 2027, you'll see governments change their mind. They'll extend out the date to 2035, 2040, 2045. Wouldn't surprise me if in the end we find out it's 2050. By the time they think that, well, let's have 30% of the fleet that's electric by 2050. That wouldn't surprise me. What happened to not increasing your applied series price? I never said that. What I did say that is, if for those who did buy it, they'll never get a price increase. They'll never be, if you have already a subscriber to the applied level, no matter what I do at this point, you will never pay another penny. There'll never be a price increase for you. It's not as if I'm going to cut it off at some point and say, okay, now you got to pay me a recurring fee if you want to keep access. You're not going to get that. It's not like I'm going to say, okay, well, I've added so much content now, everybody's got to give me another $100. I'm not going to say that. It's only for new ones coming in because it has significantly more content now. In the beginning, there wasn't a lot of content there. So for people who came in early, I said, well, it's lifetime. You'll never pay again. At some point, it won't be lifetime anymore, but not yet. Not yet. I have no plans for that yet. Anyways, there we are. That is Q&A. Sorry about the... can you hear it? That whirring, that high-pitched whirring sound behind me. It's all the fans running in that thing, cooling down all of those lights that are flashing, and I don't know what 90% of them do, really. Anyways, that's it.